Hello, income seekers, growers, and harvesters. Welcome back to the Harvesting Income channel. This channel is all about income investing, but at the same time, we also focus on how you can protect your capital or grow your capital and achieve some capital appreciation along with a sustainable or reasonable amount of yield or cash flow. Okay, today I'm going to talk about one ETF in the Canadian market. So, this is for all Canadian investors and viewers. Uh, there is an all-in-one or a diversified Canadian covered call ETF, which is known as HDIV. That's the ticker symbol you see on the screen, and it is the Hamilton Enhanced Covered Call ETF. Some of you might be familiar with HYLD, which I discussed in one of my previous videos, probably 1 year ago. But this is more focused on the Canadian market. So it is a covered call fund or covered call ETF. So let me give you a quick overview about this fund, how it works, etc. And finally, I will look at the distributions or yield, how it performed, and to give out some of my thoughts or my feedback or how this fund has done and who it could be suitable for. Stay tuned till the end because that is going to reveal some of the aspects of the fund. Because this is one of the few funds which have maintained its net asset value or grown the net asset value over a period of time. In some periods, this fund has also beaten the uh, Toronto Stock Exchange index and also beaten some of the benchmarks. So this is something that you need to look at, uh, not investment advice or recommendation. So whatever I'm discussing here is only for educational and entertainment purposes. So do your own research on that. So let's quickly get into the HDIV, Hamilton Enhanced Covered Call ETF. So what does it do basically? Like they have a lot of covered call ETFs under the Hamilton umbrella, and they are packaging all of that into one fund. So this is basically good for investors who want, good steady monthly income, attractive monthly income, and they want a portfolio which has a mix of sectors or industries similar to the S&P, TSX 60, and so it's a combination of yield plus a good amount of capital appreciation potential. On the surface, it looks like a typical covered call ETF, but there are a few nuances which I will cover as we go ahead. Let me quickly show you the portfolio. So when I come down, you can see that the portfolio consists of multiple funds from the Hamilton. Let me zoom out a little bit. Yeah. So now you can see that, yeah, it has all these multiple uh, sectoral covered call funds, different sectors or different industries focused, funds from the same Hamilton fund, and all these are packaged into HDIV. Like, for example, you have the HFIN, HMAX, EMAX, and so on. HFIN is the financials, and the HMAX is the financials yield maximizer, and you have the Hamilton Energy Maximizer, gold producers, and QMAX, which is technology, UMAX, utilities, and so on and so forth. So it has a bunch of you know funds which focus on specific sectors, and there are covered calls in those covered call strategies within those funds. And this fund is actually an umbrella, top level fund which holds all of these. Plus, there is a 25% leverage, so which enables the fund to enhance both the capital appreciation as well as the yield. Okay, and of course, there is a management fee of the underlying funds, which is like you know uh, 0.40, 0.65, depending on the fund. So you can look up the respective numbers. So I'm not going into that, a deeper level as of now. The fund was launched probably around 2021, middle of 2021, and the yield currently sits at 10%. I will also do my calculation to see where it is currently. And the assets 1.6 billion, so it's a fairly large fund with a decent size and a bigger portfolio. Yeah. So these are the basic features of the fund, and you can see that the fund is diversified across different sectors financials, I'm sorry, financials 35%, energy 15%, technology 14%, and gold 13%, utilities close to 13%, and so on. So they have a fair mix of different sectors. And when I look at the distributions, it is monthly distributions happen every month. And you can see like they have been distributing since 2021. It started with 11 cents, 11.75 cents, and went to 12.50 and so on and so forth. Like it goes up and down like depending on the performance. But currently it is at 18.5 cents. Last month in March it was like 18.30. In April it is 18.50. Like it is slightly gone up. Yeah, this keeps moving up generally, but you will see a little bit of variation. Sometimes it goes up, sometimes they reduce the distributions according to the income earned by the fund. The good thing about Hamilton is they adjust the distributions according to the actual income earned by the funds from the premium income or the option trading income. So some funds overpay, or sometimes you may see a lot of overpayment leading to reduction in the value of the fund, or sometimes overpayment might lead to higher yields in the short term. But in the long run, those kind of distributions may not be sustainable. So one good thing is that distributions that we see here are sustainable, and you can go and look up the website. Like you don't have to take my word for it. Go into the website, look into that, and if you need any information about the taxation part of it, you can look here. Uh, we are not covering the tax part here. Okay, let me show you the comparison of HDIV with other funds. I did a quick comparison on Seeking Alpha. Like I'm showing you the 1 year performance. Like HDIV is being compared with S&P TSX, which is the S&P index in Canada. And then I also compared it with XIC, which is a fund in iShares fund. I'll just open up the name. iShares Core S&P 500 S&P TSX Capped Composite Index ETF. So I'm comparing this fund with two of its comparable indices. I'm not using S&P 500. I can do that once we discuss this part. When I look at this, like the fund has actually outperformed the indices. Like S&P TSX gave like 32.2%, and then XIC 33.4. HDIV is like 36.2, like beating both of them. This is for 1 year. Like if I look at the recent 6 months, um, okay, yeah, the recent 6 months too. If you look at the performance, HDIV is at 15.15%, and S&P TSX 13.3, and XIC is at 14.3. XIC is pretty close, but S&P TSX is pretty behind in terms of the returns. And I am talking about the total returns, which is both yield plus the capital appreciation combined. And when I look at the 3 year performance, in this case too, HDIV comes on top. But when I look at 5 year, it's the same thing. It is like triple digits, like 114%, whereas XIC made about 97, pretty close, and S&P TSX 75% roughly, pretty far from where HDIV is currently, where HDIV is in terms of the 5 year returns. Now, does it mean that HDIV is the best fund, or that's the best pick? Not really. Let me show you some example or some insights here. Let me look at the year to date. This is from January 2026 to current, like around May 2026. We are in the middle or end of May currently. So if I do the comparison here, I can see still HDIV beats the other benchmarks. However, just when you observe this graph, like you can see in January, a big part of January, HDIV has been underperforming its peers. I mean, not in a bad way, but it's still covered call ETFs generally, um, underperform the indices when the indices are going up. So that's natural. But you can see the gap. You can see the gap here, like in January and February 2024. February 26, 2026. I mean, this is before the war situation started. Like February 28 is when the Iran situation started, but this is much behind that date. And you can see that HDIV is close to 7%, whereas TSX 8.8 and XIC is 9.14%. Yeah, so you can see the dramatic difference there. And even after the war started, like you can see, underperformance for a fair amount of time in March. The fund has been underperforming, and this underperformance could be attributed to the underlying stocks getting affected by that situation. Um, so if the index falls, the covered call fund also has to fall according to that. HDIV does not follow a specific index as such, so it is not going to fall proportionately, but the mix of stocks is similar to the S&P Toronto Stock Exchange Index. So you will feel that some of the movements of the HDIV is kind of replicating the other its benchmark index. So yeah, it resembles the index, but it's not exactly as per the formula in the index. So you see the similar pattern, like it's going down, and later on it recovered in early part of April, but still underperforming. In May it has outperformed. So this is always going to change, and generally speaking, HDIV is maybe slightly underperforming the index or uh, matching the returns of the index. But there are times it could outperform, and these are the current times when it is performing. And you may not see this sustain in the future for a long period of time. Yeah, it is going to go up and down a little bit, sometimes down, sometimes up. But what really caught my attention is the fact that the fund has actually maintained its net asset value over a period of time. Let me show you the price of HDIV by itself. I mean, forget about the benchmarks. When I look at the HDIV's pricing, like, let me zoom in a little bit so you can see it clearly. Yeah, this is on the Google Finance page. If I look at HDIV, year to date, yeah, it's been going up and down. It started around 2085 and went up to 2165, then again went down and again crossed $22 and again went all the way down to 20 something and then came back to 22 something and then now it's about 23, around 23 levels. Now, this can go up and down. Like there's no guarantee that you're going to get a steady price. But if you look at 1 year, it's been steadily going up. Like you can see the graph going up, barring a few times when it has gone down, like uh, middle of March or end of March, which is justified. Like we know the situation happening, geopolitics, uh, and all that, oil prices, inflation, and there are different aspects to it. That's why you see this down, and then in April, around end of April, May, it's again caught up. Like so, you can see that peak in Feb 26 or so, and then it fell down all the way to 20 something, $20 in March 20th, and then it came back in April, and then in May it's come back to 23 level. So it's showing a good signs of recovery and the ability to appreciate. So the capital stability or the NAV stability seems to be good for HDI. And if I look at the 5 year chart too, there are a lot of ups and downs. I think in 2022 there were a lot of changes in the fund, or some of the strategies were being reorganized. So that's why you see a big change here, like a lot of ups and downs. And it took some time in 2023 for the fund to stabilize. I've been holding this fund for quite a long time, and for me, this is one of the core holdings. So when I say core holdings, meaning like I would like to hold this because it can dynamically adjust according to the different market conditions. Goes up, then it can capture the capitalization and give me more value. What if the market is down or flat? I can expect some kind of distribution that is very steady, and the frequent income distribution makes me comfortable. And when the market is down, when I get that distribution and I have the cash, I have the opportunity to buy more so that I can add more uh, units for long-term wealth creation. And that is the whole point of investing, right? You're not just investing, just for the yield and just to see that big yield number. Like you want that capital appreciation because in the future, let's say you hold hundreds of units and you go uh, to the future. Let's say imagine 3 years from now, you need some money and you want to sell a portion of your units. You have like 500 units. You want to sell 100 units and take out that cash. Imagine that if the value of the fund goes from 23 to $10, it would be devastating. It would be you will collapse because your fund value has gone down by 50% or more, and you're getting less money now. So that's why the appreciation is important. So I want to just make a quick point here. From the recent times, you might have seen I have reduced the amount of videos or content because I'm now focusing on how you can balance capital appreciation plus income so that you can get the overall total returns that will help you build wealth over the long run. So that is going to be my focus going forward. Like it's not just chunking out videos every day or every week. uh, yeah, I will maintain some frequency, but it is also about quality. It's also about how I can uh, give you the true picture about total returns, which is a mix of income plus capital appreciation. And these two aspects also come from different aspects. For example, capital appreciation could come from appreciation of the price of stocks or the type of options written out of money or at the money options. That also determines how much of capital appreciation you can get. And secondly, also the distributions are not just from the covered call premium. You also get dividends from the stocks, underlying stocks, and that can also get distributed by the fund. So there are different ways in which these portfolios are structured. And I'm going to come to that now. Now is the interesting part. Stay tuned. I will just switch gears here, moving on to show you how the fund has done in terms of yields and in terms of the um, what are the different strategies they follow. I'm not going too much into the capital appreciation part because I've already shown you the price increase chart in Google. Now let's look at the price. Current price is around $23.03. Let me zoom it so you can see it on the screen. Okay, I think now it looks better. This is as of May 20th, as of this recording. Now, when you look at the last 12 months distribution, it adds up to $2.14. I have literally taken the 12 months distributions, added it up. It comes to $2.14. So that's the number we are going with. And when I divide that $2.14 by the market price, 2303, it's about 9.3%. It's not 10% as reported on the fund website. Let me quickly show you that as well. So on the website it says 10. Probably it could be due to the difference in the dates. So yeah, so it's about 9% as per the latest closing price on Friday, that is May 20th. So the yield is not like super attractive. Like earlier, you could see yields going up to 12%, 13%, or even 14%. So as of now, the yield looks very small, but bear in mind that you see the small yield because the share prices, the ETF prices appreciate. You see the same trend in even in dividend stocks. Like you buy a dividend stock and you get a good yield, but at some point the stock gets attractive and people buy it, appreciates. The appreciation is also good. Like, it's not a bad thing, but you will have a slightly lower number on the yield because the current price is higher. However, bear in mind, like if you are someone who is holding this fund from last 3 years or 4 years, like me, then your actual yield on your cost is going to be much higher. Probably you are sitting on 14, 15% yield, which is very attractive, right? Think about a savings account or any other options. How much you can earn from that? There's not much you can make out of those accounts, right? So this is the maximum. This is the good yield, I would say, for this kind of fund. But yield is only one aspect. There's a capital appreciation aspect. So let me break it down for you. This fund is able to maintain the asset value because there are two portions on the fund. Like I am explaining that in this table below. 30% of the fund is used for covered call writing. So only the 30% of the fund is covered, which means 70% of the fund can have full appreciation, no cap. So there are funds which write almost 100% or 80% of the portfolio, which means that their capital appreciation is capped at the strike price, or sometimes they write uh, calls at the money, which means appreciation is completely capped, no appreciation, only more income. And those funds will pay you dividends, but you will not see appreciation in NAV. You will instead see the NAV going down. Every week, every month, you keep checking the price, it keeps going down. And at some point, you get frustrated. And it's not you, I'm not judging anybody here. It's also the same experience that I have had with some funds. And I've also had very good attraction to these weekly paying funds because I thought that the premiums are going to compensate me for that NAV depletion. It it does work sometimes, but that has to be a very small portion of your overall portfolio, and it has to be a small portion where you want to test it out to see if you can get that cash flows in and make that cash flows work for you. So that's one part that we are looking into. But the other part is like you want to have a fund which is more like an balanced all-in-one fund, so which can give you the mix of income plus appreciation. And you don't want to sacrifice the appreciation because, as I told you, like 3 years or 4 years down the line, you want to look back into the portfolio. You need some funds, or you want to redistribute the portfolio, rebalance it. You find that the NAV has dropped down, then it's going to be highly disappointing. Okay. Having said that, now quickly let's look at each scenario. Let's look at the uncovered portion, which is the easier part, where there is no covered calls. So this part, the fund can grow the NAV. Like the NAV can go up, can go down also. Like so, there is a downside risk also because if the stocks go down or market goes down, then this fund is going to lose value. But if the market goes up, portfolio goes up, then it's going to go up. So it's a proportional to the market performance. And income generation wise, the only for income you have is dividends. Of course, the fund can also make some gains on the capital appreciation part, but that comes under the capital appreciation. The fund can sell some stocks that at a profit, or sometimes they can also sell underperforming stocks and just try to weed out the underperformers and add more of the good stocks. And sometimes they can sell a part of the good stocks when it is going up like crazy. Like for example, if the company's results are very good and it goes up by 20% in a day, like maybe the fund decides to book some profits there. So those are all the ways in which the fund can manage the you know the profits and losses, and finally they want to give you NAV appreciation plus also regular income. So the uncovered part of the portfolio, which is 70% of the portfolio, works like a typical diversified portfolio. Okay, basically capital appreciation from the stocks and the dividends. Simple. And this part actually forms the core of the portfolio. So you don't have to worry about covered calls for this 70%, like because there's no covered call here. It's only individual stocks. Now, coming to the covered call portion, which is 30% of the portfolio, this is key here. Now, when they write covered calls, they write at the money calls. At the money calls means they write the call strikes at the current market price. Let's say the current market is around 7,000 points, for example, S&P 500. I'm just taking a rough example. So they would write calls around that level. Now, if it is going, in this case, it's going to be individual stocks. For example, if let's say Microsoft is at $450 and they hold that stock, they would write covered calls around the 450 level, like very close to that level. That is at the money, which means that if the call gets exercised or assigned, if the Microsoft stays above 450, then the fund is obligated to sell Microsoft at 450. So when the price goes up, the fund cannot get that capital appreciation because the uh, the upside is capped at the at the call strike level, at the option strike level, which is $450 in this case. So In terms of income generation, the income is pretty high because at the money call will have a higher income. For example, if Microsoft is at $450, you write a call at 450, you'll get maximum good income, very good income. But if you write a call which is at $500, you're going to get very small amount of income. So that's why it's a high income. Whereas in the capital appreciation point of view, you are not going to get upside. Uh, in a good scenario, let's say Microsoft drops below 450, so the fund can keep the stock and they can write another call option in the future. So yeah, there is a scope for Microsoft to appreciate because you're still holding that stock, but that's going to be none or minimal. Like you're not going to get high amount of appreciation. Okay, so you are actually getting a good amount of income, but no upside for this 30% of that portfolio. So think of this like a kind of a sandwich position. Like you already have the meat or the filling in the sandwich, which is loaded by this 70%, and you have this 30%, like just like an extra butter or like extra cheese to enhance the taste or to make it much better. That's how it works. So the covered call part of it is not actually uh, damaging the portfolio, or it's not trying to dominate the portfolio. Like, so it actually adds more value to the portfolio. So what this means for you, like the first part is clear, it works like a diversified portfolio, but the second part, the uncovered portion, 30%, there is a chance that the stocks, good stocks which go up, they get called away because the buyer of the call will take away the stocks because the stock appreciates, the call buyer is gaining, right? They're making profits. Obviously, they will take away the stocks because the stock options are sold at the money. It's close to the current market price. And the fund is able to generate good amount of premium. And the other good news is the fund is also able to quickly, buy and sell those stocks. Like it is a kind of a trading strategy in a way. So they're able to generate that quick amount of income, uh, and probably on weekly calls or monthly calls, and that enables the fund to generate income on a monthly basis. And this income is attractive because it is these are calls written at the money. If it was out of money calls, the income will be less, but there is a higher chance of capital appreciation on those calls. There are some funds which write out of money calls. I'll come to that shortly. Now, when I looked at all this, I mean, this fund also has certain pros and cons. The cons would be like there are different funds that this fund holds, so you cannot expect uh, a performance which is exactly similar to the index because there are a lot of components within the portfolio. Like there is a gold component, there is a QMAX, there is a utilities component, there is a technology component. Like so, since it is a mix of diverse sectors, so it's going to be little, there's not going to be a super performance, or there's not going to be a super downside as well. It's going to be a balanced performance, and that's a pro for the fund. But for some people who are looking for that, you know, home runs, it's going to be difficult to see that in this fund. Over a period of time, you will see the good performance. Okay. Another unique thing about this fund is HFIN and HUTS, the two funds which I mentioned below. I'm just highlighting the key points which I found interesting in this fund. And these are positive. And in some cases, yeah, there are risks as well. So HFIN and HUTS. HFIN is the financial ETF within the Hamilton portfolio. And HUTS is another fund which is the Hamilton Utilities ETF. So these are the ETFs covering the financials and utilities sector, and there are no covered calls here, so there is no upside cap. So let me explain that. I'll show you the portfolio. Okay, so you can see all these fund names in the you know HDIV portfolio. There are 10 funds, and most of these funds have the name Max, which is the maximizer ETFs. These are all similar in terms of design or strategy. They try to maximize the yield. So these are maximizer ETFs. And there are some Daymax ETFs. So these are ETFs which are purely covered call or zero DTE funds. There are two funds which are unique, HFIN and HUTS. HFIN, Hamilton Canadian Financials, and HUTS, Hamilton Enhanced Utilities. These two are pure sectoral ETFs. They don't write covered calls. They have stocks within them in that specific sector, but no covered calls. So if there is no covered call, there is no upside issue. So the upside is unlimited, and you also have scope for unlimited capital appreciation and scope for dividend income from those stocks. So utility stocks are known to have good amount of dividend yield. Similarly, financials also have good amount of scope for dividend yield. And so if you look at the numbers, HFIN is about 21.6% and HUTS is about 4.3%. So roughly 26% of the portfolio is actually non-covered call version. So the total will be like 125, but out of that, about 25% of the portfolio is no covered calls. The reason why it's 125 is there is 100% of the portfolio, the stock holdings, plus 25% leverage or the borrowings that fund uses to enhance the returns. So yeah, so that's long story short. There is a component of non-covered call also in the fund that enables the fund to achieve some capital appreciation. That's one aspect of it. And for all the other uh, maximizer ETFs, they write calls on only 30% of the portfolio, not big chunk of the portfolio. So 70% of the portfolio still has unlimited upside. So if the market had rallied like in the last 6 months from below 7,000 levels to currently around 7,400 or something like, I don't know what's the percentage, but you can do the numbers. That's a dramatic increase. And a lot of stocks which are in this portfolio would have increased at the same kind of same pace or maybe at a smaller pace, but still you would see that dramatic appreciation. So when that dramatic appreciation happens, you have to see not only appreciation, but you will see increase in the distributions. And that's what I pointed out when we saw the distribution side, that recently you see the jump up, like in October 2025, from 18 cents it went to 18.30. Uh, I'm not sure exactly how the market situation was back in the day, but when you see this, like it's 18.30 for last 1, 2, 3, 4 of these months up to end of March. In April, they again bumped it up to 18.50, like 18.5 cents. So may not be a big bump, but gradually they are increasing the distributions to match up with the earnings or the income of the fund. So that's a good way of rewarding the investors when things go favorable. Yeah. So coming back to the key points that I was discussing. The second one would be leverage. Okay, one warning that I want to say is leverage can work both ways. Like if if the fund performs well, the leverage is going to increase the returns by 1.25 times. So if the fund makes like 10% returns because of the leverage, the fund will give you 12.5%. Underlying goes up by 10%, the fund will give you 12.5 because of the leverage. But if the underlying stocks go down by 10%, roughly, then the leverage is going to multiply that as well. So on the downside, it will go to 12.5%. So leverage is like a knife which works like a double edged knife, which can, be good and bad at the same time. But here it is good for different reasons because the fund uses leverage selectively, and uh, and this leverage is provided to a financial institution like Hamilton Asset Management, Hamilton Funds. So when we borrow, like individuals, we borrow from bank or we take a loan, for example, line of credit or any loan. The rates are pretty high, but when these institutions go to the big banks and they get the financing, the rates provided to them is very close to the prime rate plus a small margin. But if you take any line of credit or any loan, you will be slapped with something like 15%, 18% interest. And if you have to take a leverage and do the same covered call strategy, then you will have to make that interest plus more returns, and you'll have to make like very high returns to pay back your leverage and still make gains. So this is something that is advantageous for retail investors who don't have access to leverage. And leverage is only good if you are investing for the long run. In the short run, it may or may not work because the performance of the fund depends on the market performance. So if you are looking for a short term or medium term, then don't look for a leveraged fund. Look for other options. So yeah, if you're looking for long term, this perfectly works. So going to the next, covered call on stocks not index. Yeah, that's key point that you need to keep in mind. You when you look at the website, when you look at all the material on Hamilton, this doesn't stand out. Like it doesn't stand out that they are writing uh, calls on stocks. Like they say in different places that they write at the money calls, but it doesn't specifically state. You have to go around and then find it. I did the hard work for you. So basically, they write covered calls selectively on their underlying stocks in the portfolio. So when they have these underlying ETFs, and those ETFs have some stocks, on those stocks, they write calls. So when you write calls on stocks, stocks are highly volatile. So that's why you get higher premiums with stocks. So that's the reason why they're able to deliver higher income in terms of attractive monthly yield on top of capital appreciation. So that's the kind of holy grail that HDIV is following. And HYLD, which is from same fund, which is the US version, also has similar kind of features. So yeah, when you look at XYLD or XYLG, they don't have that kind of yields in when the volatility is low because um, even though they can do you know generate that kind of yields, but sometimes the index moves up and down and stabilizes. Like you don't see the fluctuations in the index happening all the time. Like only in certain times you see the index going volatile. But stocks get more volatile in different parts of the year. And one of the key times they get volatile is during the result season, and also they get volatile in different times of the year when there is special announcements, geopolitics, or Federal Reserve announcing interest rates and so on. Like there are different points of time when stocks get very volatile, and HYLD is able to harvest those volatility in the form of premium income. Now, the I'm going to the last part of it. So, if you liked what you're watching so far, and if you love this content, please feel free to share and also hype this video if you liked it. And any comments, any feedback, feel free to share them below. Yeah, there was one good question, asked by someone. Uh, why don't these funds write out of money calls? Like, why should they write at the money calls? Okay, so the problem with that is out of money calls is you get lower amount of premium, and these funds are income funds, and they have to show some kind of yield. So, although the out of money calls are good for some income plus more scope for capital appreciation, out of money strategy is kind of superior to the at the money strategy in some ways. Every strategy has its pros and cons. I'm not trying to debate that, but out of money strategy is actually superior in certain ways for medium to long term investors because it gives you that scope or that headroom for higher appreciation. Even when you write the covered calls, even on the covered portion of the fund, you can get some appreciation because you're writing out of money, which is higher than the current price. So you want the stock price to go up a little bit before it hits the call strike price. So out of money is a good strategy and it's a valid question. Like I would definitely encourage you to look at funds which write out of money calls. But if you know any funds which do that, please type it in the description or comments below. I would like to cover that in the future. One of the funds that actually does this is the DIVO. DIVO. Okay, the name of the fund is it's on your screen. It's called the Amplify CWP Enhanced Dividend Income ETF. Okay, just a quick disclaimer, this is not a recommendation. This is just a fund which I liked, I came across. I'm still researching on that. This fund, I have covered it in my previous video. So I will put a link in the description to my previous video. You can watch that. And this is a fund which is a core dividend and earnings growth oriented fund. They pick stocks which have good dividend yields or potential for earnings growth. And basically, they are betting on capital appreciation and dividends, just like any diversified fund. However, they use covered calls on select stocks only if it reaches 5% above the current price, like 5% or 10% out of the money. At that point, at that level, they write the covered calls. So basically, they are doing a tactical covered call strategy on a very selective basis. So they are using the covered call as a small feature, not as the main feature of the fund. So that's the difference. HDIV is also doing something in similar, on a similar lines, but DIVO is far superior because they are writing out of money calls. So they are actually one or two steps ahead of HDIV. And this is a fund from the US side, which I like. I'm going to cover that, and probably I'm thinking of adding it in the future in my portfolio as well. So that is one thing you can check out. You can also look at my previous video. I hope you like this video and this presentation. And if you have any questions or any comments, please drop them below. Have a great day. Happy investing.